So guys, welcome back. Just now before the break, we have seen what is audit risk. Now in this particular lecture, we are going to discuss what are the components of audit risk. Components of audit risk. Just before the break, I told you audit risk is equal to risk of material misstatements and detection risk. Then risk of material misstatement is having again two components, inherent risk, control risk, and this is detection risk. So what is inherent risk? Inherent risk means there will be material misstatements in financial statements, whatever you do before taking any internal control systems into consideration. That means it is something like mistakes do happen. It means you are riding a bike or you are driving a car in your lifetime, you will hit someone or, there will be some minor accident. So it is as simple as if you are a doctor, you cannot be 100% accurate. If you are a driver, you cannot be 100% accurate. So you prepared financial statements of an entity, even in the best or good faith, considering your extremely good capabilities, even then there will be some mistakes or there will be some frauds and errors in the financial statements. There will be some misstatements in the financial statements. This is what inherent risk means. We'll see about inherent risk little later. Then there is a misstatement, but if you as the management of the entity or as those charged with governance, you should be able to keep certain operational controls or certain internal controls on financial reporting or internal controls on certain other matters, prevent or detect this kind of frauds. You should not have allowed this fraud to happen. You should not have allowed this error to happen. You should not have allowed this to happen. But if your controls are weak, this is a control failure. This is a control failure. That means I have either no controls or I have either weak controls which were unable to prevent and detect errors. Because of this, the management is unable to prevent and detect material misstatements. So now look at the overall picture. One, material misstatement happened. Two, management is unable to prevent or detect it. That means management failed, internal audit also failed. Imagine, management failed, internal audit failed. Now it came to external auditor, statutory auditor stable. At least you should be able to detect it. Problem is here, audit procedures or techniques you have applied. You have applied certain audit procedures or techniques, but the audit process was not effective. Audit process was not effective to detect such material mistake. Because of this, what happened? You gave an inappropriate opinion. Because of this, finally, the auditor has expressed an inappropriate opinion. So what is the story? There is a material misstatement, inherent risk. This material misstatement was not prevented or detected by the internal controls of the company, control risk, and the auditor was not able to detect that material misstatement, detection risk, because of which he expressed inappropriate opinion. Now imagine the moment you have given an inappropriate opinion, shareholder will catch your collar and ask you, Companies Act will catch your collar and ask you. Regulatory authorities like, it could be RBI, it could be SEBI, it could be stock exchange, or it could be Insurance Regulatory Development Authority, it could be a court of law, it could be NCLT, National Company Law Tribunal, it could be some stakeholder who will catch your collar and ask you, hey, you have given inappropriate opinion. Step 1, there is a material misstatement in financial statement. Step 2, it was not prevented, detected by the internal control systems. 3, the auditor was not able to detect it. Because of these 3 reasons, auditor has given inappropriate opinion. This is audit risk. This is audit risk. These are 3 components. Now look at the material. Risk of material misstatement, this one. Risk of material misstatement may be defined as risk of material misstatement. I have written RMM. So many places I have written RMM. What is RMM? It may be defined as the risk that the financial statements are materially misstated prior to the audit. I have not even started the audit. When financial statements and notes to accounts, already material misstatements are there. This is called RMM. Why it is there? Because of 2 reasons. One is inherent risk, another one is control risk. So again, as I told you earlier, students feel little difficulty in understanding what is inherent risk and control risk. But again, I am telling you, at the risk of your repetition, time and again, I am telling you the same thing. The concepts are simple. Read it. The language is heavy. Read it. What is inherent risk? The susceptibility. Oh my God. One weapon. ICI is using all the astras. Okay. One Brahmastra came. Then of an assertion, one Pashupatastra came. To a misstatement, one Narayanastra came. So all the Trinity, 3, superior gods, whoever are there, all the astras came. That could be material before consideration of any related controls. Surprisingly, whatever is highlighted, embossed in that bold letters by ICI, that is understandable. Before consideration of related controls, okay. What is susceptibility of an assertion to a misstatement? That could be material. Susceptibility, underline and write down. Susceptibility means likely. Likely. That means there is a possibility. There is a likelihood of, there is a chance of, there is a probability of. Susceptibility means chance of happening, likelihood of happening. So there is a likelihood. Okay. That means there is a possibility of. What is assertion? Assertion. Do you remember in earlier classes we have covered assertions? What are audit assertions? There I have given a beautiful diagram also with the 3 arrow marks down. Assertions, 3 arrow marks down. Assertions in case of transactions. Assertions in case of balances. Assertions in case of presentation and disclosure. For example, completeness is an assertion. Valuation is an assertion. Completeness, whether all the transactions are properly recorded or no. Completeness. Valuation, whether the item of financial statement is measured properly or no. Okay, whether it is presented properly or so. These are called audit assertions, what auditor is looking for. So in some of the assertions, for the sake of ease, let us take assertion. One of the assertions we'll take so that you'll understand it. Okay, valuation. Say, for example, look at the background. Do you remember in SES 701 key audit matters paragraph, I have opened Reliance Industries financial statements and I have given you one beautiful live example that the additions to non-current assets during the year were 1 lakh crores. What? So Reliance Industries has added to their non-current assets, they have added during the financial year around 1,09,000 crores, 1,09,000 crores, 9,000 crores. So that is addition to non-current assets. That means that much of fixed assets they bought. Okay, now let us look at the measurement. You know that whenever you buy any fixed asset or property, plant and equipment, it has certain inclusions, it has certain exclusions, and you have studied the whole thing in, your Ind AS 16, if you are a final student, or accounting standard 10, you are CA intermediate student, you might have studied the whole story. So you need to take the cost of purchase, less rebates, then, any taxes, if they are non-refundable, what to do, if they are refundable, what to do, directly attributable expenses, how that can be added, borrowing cost, how that can be considered, all these things, you remember? So that is measurement. Now my question is, when I'm conducting audit of Reliance Industries, whether this 1,09,000 crores is strictly correct amount, or they might have added something which should not be added. They might have subtracted something which should not be subtracted. So if there is little change, that is a misstatement, isn't it? That is a misstatement. So let us look like this. Let us look at this. An amount which is existing in financial statements is wrong. An amount which is existing in financial statements is wrong. Why? Has it, any connection? Does it have any connection with internal controls? No, sir, there is no connection with internal controls, but there is a material misstatement. So the susceptibility that an assertion like valuation is materially misstated before considering internal controls. You understand? So simple, mistakes do happen, full stop. Mistakes do happen, full stop. Accounting errors do happen, full stop. Frauds and errors do happen, full stop. Maybe some mistake in application of either accounting policy or an accounting estimate or in some calculations, some mistake will happen, full stop. That is what it is. The susceptibility, that means the likelihood of assertion, valuation. The example we have taken is valuation. There can be any number of assertions, valuation, but it could be materially misstated. 1,09,000 crores is materially misstated. That means there is some 4 or 5 crores of difference is there before considering internal controls. That depends on the nature of the asset. That depends on the expertise of the person who's measuring the PPE. It has nothing to do with internal controls. This is point number 1. Now look at control risk. The risk that a misstatement could occur in assertion could be material. So instead of writing the first 4 lines, they can say material misstatement. Simple. The risk that material misstatement will not be prevented or detected or corrected. If you look at this internal controls as per CASO framework, but of course in CA, both at intermediate level and final level, this CASO framework is not there, which is taken from, United States courses like maybe CPA or CMA US. There you'll read there are 5 different types of internal controls. Internal controls can be preventive controls, internal controls can be detective controls, internal controls can be corrective controls, internal controls can be compensative controls, internal controls can be directive controls. So there are total 5 types of internal controls. Normally in Indian textbooks, we speak only about the first 3. So internal controls are supposed to prevent the correct misstatements, but if they fail, it is called control risk. It is called control risk. So I am the auditor, you are client. I am the auditor, you are client, or you are finance manager of the client, you are accounts manager of the client. I asked you, hey, why this misstatement is there in the books? Why this material misstatement is existing in the books? You said, oh my God, Pavan sir, sorry. Our control systems are either non-existent or weak to prevent, point number 1. Detect, point number 2. Correct, point number 3. This misstatement. If I have a strong control to prevent, this misstatement would not have come into the books. Today, Pavan sir, you will not catch my collar and you will not ask this question, why this misstatement, material misstatement is exists in the books? Because preventive controls failed. Unfortunately, Pavan sir, even if we fail to prevent something, but if that happens, we do have detective controls which detect fraud and error. Unfortunately, that also failed. Because we are unable to prevent or detect error or fraud, we were not in a position to correct it. Had there been a situation where it comes to our knowledge before you came for the audit, before Pavan sir, you came and you started the audit, If it comes to my knowledge as the management, that there is some fraud which has happened or is happening, I might have prevented it or I might have detected it and we might have corrected it before you come. I'm so sorry to tell you, we failed in prevention, we failed in detection, we failed in correction. You caught my collar. Sorry. This is called control risk. This is called control risk. Now imagine you failed to prevent, detect, correct. If I fail to detect it, that is audit risk. So these two inherent risk, control risk, you understood. Below that, there is, control risk. Below that, that is detection risk. Look at the detection risk. The risk that here, detection risk, the risk that the procedures performed by the auditor. Oh my God, what are the procedures? Again, CA 500 audit evidence. There, do you remember you have applied certain procedures to obtain audit evidence? What are the procedures? Risk assessment procedures. Oh my God, further audit procedures. You remember? Risk assessment procedures, further audit procedures. RAP and FAP we call. RAP, risk assessment procedures. FAP, further audit procedures. What are they? You remember SCA 300315? And in further audit procedures, there are again, in further audit procedures, there are again tests of control, substantive procedures. Tests of controls is nothing but evaluation of internal control system. Substantive procedures again can be tests of details, analytical procedures. Tests of details again can be tests of transactions or tests of balances. Tests of transactions is called vouching. Test of balances is called verification. Oh my God. You have applied all these things. As an auditor, you have applied all these things. What are they? Combined, put together, they are known as audit procedures. Risk assessment procedures and further audit procedures. And you might have remembered that 7 types of audit procedures also: inspection, observation, inquiry, analytical procedures, recalculation, recomputation. You remember all these things. Reperformance. They are audit procedures. So you applied all the audit procedures, but the risk that the procedures performed by the auditor to reduce the audit risk to a low level will not detect the misstatement that exists. That means there is a misstatement existing and you're an idiot. You're unable to detect it. Khatam, full stop. Isn't it? So there are 3 components: inherent risk, control risk, detection risk. That 3 put together, audit risk. That's all. So they have given, what is the meaning of, inherent risk here. All these things we have discussed. On the right hand side, if you see components of risk of material misstatement, there are 2 components: inherent risk, control risk. Then they have explained inherent risk. What is that? Then they have control risk. Then they have discussed, detection risk. That's all. After that, they started with SCA 315. This we'll see in the next lecture. Okay. So in chapter 4, first, we learned what is audit risk. Second, we have learned what are the components and what is the meaning of that 3 components. That is what we have done till now. So any doubts till whatever we have discussed today?